Welcome to Bloomberg Markets. I'm Ivani Quinn. Former President Donald Trump due to speak moments from now at the Economic Club of New York, where he's expected to detail his economic platform and also answer some questions. We'll bring you that live this hour. First, let's get a quick check on the markets, where we are at session lows now for the indices. Interesting to note, the equal-weighted S&P down more than the cap-weighted index, thanks to the SOX index rebounding ever so slightly after a tough week. But just in the last few minutes, actually, fewer components of the stocks are higher. The Philadelphia SOX index now is lower on the session, with just about 3 stocks there higher. But we are seeing a little bit of a rebound for the likes of Nvidia. Bank of America today saying the pullback has created an enhanced buying opportunity. And then if you look at the 2-year yield and the 10-year yield over the last day, it's been quite the hallelujah moment, to quote John Authors of Bloomberg Opinion. We saw a curve disinversion. But what does that mean? We're going to get answers in just a few moments. Right now, we're at 375 on the 2-year and just barely pipping it lower, 374.58 on the 10-year. So let's get straight to a discussion now about the Treasury market and what it's telling us exactly with the yield curve, with Gene Tannuzzo, Global Head of Fixed Income at Columbia Threadneedle Investments. So in a sense, Gene, this has been the moment we've been dreading and waiting for, this disinversion of the yield curve. Are we headed towards recession now for definite, or is it something this time round that's a little bit different?
Well, I think you're right, Vani. The tides are turning, but I think the change in the yield curve tells you something very simple, which is that now is the time that the front end of the yield curve is going to start coming down. There's been a lot of discussion over the last couple of years about how the inversion of the yield curve would be resolved. Could it be the long end moving up, or a variety of other factors? But as you look through cycles on average over time, it's when the Fed starts cutting in earnest that you start to see that disinversion. Now we have to think about, why is that happening? Right now it's happening mostly for good reasons, because inflation has come significantly down. A couple of years ago, that CPI was creeping around the 9% level. In second quarter, CPI ran at a 1% annualized rate. So that's a very different backdrop. On the other hand, the labor market is just starting to rear its head as a concern. The Fed has not had to worry about the labor market for quite some time, but we heard from Chair Powell at Jackson Hole that that's starting to change. So for now, it's good news reasons, lower inflation, that the yield curve is disinverting. But what we got to keep an eye on in the future is, does that labor market deteriorate to a point where the Fed has to move not just to sort of a normal long-run interest rate, but a more accommodative lower interest rate?
Yeah, and just this morning with ISM services and also ADP data, we saw a little more weakening in the labour market, but still with the services data, we did see expansion in the labour market, and also ADP wasn't terrible, right? So it seems to be just the right amount of weakening. That would be some camps' opinion, at least. So what does that mean for the 50 versus 25 debate? Is the market clamoring so much now for a 50 basis point cut that we're going to see disappointment and maybe bewilderment if we only get 25?
I think there could be a little bit of volatility around that first move. Remember, even the first move on the way up in 2022 was only 25 basis points, even though it accelerated after that. It's possible that we see some noise in a similar magnitude on the way down in interest rates. But I think the size of the move in September is not the most important thing. I think we need to look at the total quantum of what the market is pricing in, which is simply that over the next 12 months, the Fed gets down to that neutral rate, that 3% rate. And really the market over the next 9 meetings, which occur in the next year, is pricing on average 25 basis points per meeting. I think that's perfectly reasonable and still leaves bond investors the upside if the Fed needs to cut faster in response to a weaker labor market.
So that would be nice, Gene, but it seems like we might get, as you say, volatility between now and then. Maybe, yes, in total, there will be sort of 25 basis points spread out over 9 meetings. But, we are going to see for sure a decision on 50 at some point this year, unless the market reprices significantly, because we're pricing more than 100 basis points for the rest of the year right now. So post payrolls tomorrow, if the market trades higher in price, are you a buyer or a seller, or are you doing nothing?
I think if a weaker labor market definitively is what's driving that, I think it's an opportunity to continue to stay long or get long if investors are not already positioned that way. I think as we look at the drivers of Fed policy, 25 basis points is a nice, convenient forecast, whether it be from the market or from the Fed. But to do that consistently for a year in an easing cycle would be highly unusual, actually unprecedented. Typically, the Fed is easing in larger increments in response to a shock in demand. That shock in the demand could come from a weaker labor market if we see evidence of that tomorrow.
The other thing that's playing into this is oil prices, right? We're seeing, even though we got that OPEC Plus extension by 2 months, we're seeing WTI still trade below $70 a barrel today and Brent just above $73 a barrel. Does that give us some pause regarding global demand that might feed back to the United States?
I think if you look at commodity markets or even break-even inflation or TIPS markets, they're telling you that demand is a concern globally, particularly on the industrial side. As we look at readings of economic growth globally, they're still positive. They've really returned from a more robust level a couple of years ago to a very sort of calm pre-COVID level, maybe a 2% real growth rate in the US, for instance. But there is evidence of potential additional slowing. And I think commodity markets are giving you a little bit of an amber signal at this point that perhaps inflation and demand are lower than what the market thinks if we were only to look at the last couple of GDP prints.
So, Gene, you say the next move is lower for twos. Where do we end the year on twos, and will we have a positive yield curve by the end of the year?
Well, I think the yield curve is going to move towards where the Fed is moving, which is right now that neutral rate of 3%. So I think we'll slowly see the yield curve move towards that level. I think that'll also give it an opportunity to steepen, and to the extent that the Fed does realize that greater than expected shock in demand, which we haven't yet seen, but if they do, that takes the front end into more accommodative territory below 3%. So I think in the near term, there's reason to be excited, and I think the reality is we're not that far away on the 10-year Treasury yield from where we started the year. So investors haven't missed it if they haven't invested yet, but there are opportunities throughout the bond market to re-engage.
It seems a little bit of a scary scenario to actually, go for it, to put yourself all in there when there's still so much uncertainty, and of course the election as well. Do you anticipate that there will be a lot of volatility in the weeks before the election?
There could be. I think the concern is less about one party or the other. But if we did see a single party sweep, as we did in 2016, for instance, that would give the market some concern that perhaps we could lose fiscal discipline as one party was really sort of moving towards its agenda and expanding deficits. And we can have a little bit of that deficit scare like we had about a year ago. But I don't think that'll be the primary driving force. And I think the biggest thing about the election will be moving on from it once it's over from a market perspective and thinking about real tangible policy, which isn't something that the market has traded on up to this point. So I don't think the election is the critical element for the Treasury market at this stage unless we see that single party sweep, which gives the market some view on future policy.
All right, Gene, thank you so much for joining us today. That is Gene Tannuzzo, Global Head of Fixed Income at Columbia Threadneedle Investments. Former President Donald Trump due to speak any moment to the Economic Club of New York. He's expected to share his economic platform, perhaps give us some more details from what we already know. There's also going to be a question and answer session. Obviously, those remarks haven't begun yet. We will bring them to you live. For more on what to expect, though, from the event, let's bring in Bloomberg's Kayleigh Lyons in Washington, D.C. So, Kayleigh, we do have a few outlines of what Trump is anticipating that he wants to do. We're obviously going to hear a little bit about things like immigration, tariffs, and so on. What are we anticipating?
Well, if the reports in advance of this speech, Vonnie, are to be believed, we will get the outline of a few new ideas from Donald Trump, including the potential creation of what he's calling a government efficiency commission. If that sounds vaguely familiar, maybe because this was something that was discussed between him and Elon Musk in that X Spaces last month. So this is essentially something that would audit the entire federal government and look for areas of waste that could be cut. So that's one thing we could expect to hear. In addition, we also expect to hear more on tax policy. The Wall Street Journal reporting today he's going to suggest a 15% corporate tax rate on companies that make products in the U.S. Of course, he's already said he would like to see the corporate tax rate lowered overall. He wants to make his tax tax cuts from 2017 permanent, and also, of course, is proposing no tax on tipped income. Now, Bloomberg has crunched the numbers on that. With the collective proposals he's put forward on taxes, this is something that could cost $10.5 trillion over the next 10 years. And in comparison, there's only about $9.8 trillion in non-defense discretionary spending projected over the next 10 years. That means you could cut everything essentially that there is to cut, and still those tax cuts would not be fully paid for. Now, you mentioned tariffs, Bonnie. That's something else we could hear more about, as he suggested 10% tariffs on all imports coming into the U.S. and even greater, potentially up to 60% on everything coming from China. So expect to not only hear him talk about those policies, but also potentially be pressed on the economic impact of those policies when it gets to the Q&A with the chair of the Economic Club of New York, Bob Steele. Of course, economists will tell you that a lot of these policies could be inflationary and potentially even impact growth, if Goldman Sachs' research out this week is to be believed. So that's going to be something we're looking for him to more define what he actually thinks economic outcomes could look like under this platform, and expect him to take a few swipes at the platform Kamala Harris has put out as well.
Exactly. And Kayleigh, you mentioned that idea of a government efficiency commission. Terry Hines writing this morning that that would be a recipe for doing nothing for a long time in markets time, all the while pretending to act and not delivering half of what the street thinks might happen. I mean, to an extent, a lot of these platforms are dependent on what happens down ballot, right?
Yeah, that's absolutely right. And the same goes for the proposals Kamala Harris has put forward. She, of course, yesterday outlined an expansion in the small business tax credit she would like to see, and would like to see the capital gains tax for the highest earners, $1 million and above, raised to 28%, the corporate tax rate raised to that level as well. But all of that requires congressional buy-in. And unless we see a full Democratic sweep in Congress come November, then she's not going to be able to get that done. The same goes for the policies of Donald Trump, who, of course, we see now is taking the stage at the Economic Club of New York. Exactly,
and we are anticipating that he is going to be speaking just any moment now. Kayleigh, all of this, of course, setting the stage for, as you say, next Tuesday's debate, which has been eagerly anticipated and is now going ahead. We even have the rules for that debate.
Yes, ABC has finally finalized those rules, and the Harris campaign has agreed to them. The one area of dispute was whether microphones would be muted when it's not the candidate's turn to speak. That will be the case, as was the case in the CNN debate back in June, Bonnie.
All right, Kayleigh. Well, this microphone is not muted. It is, in fact, in Midtown Manhattan, and it is the former President Donald Trump taking it now. So thanks to you, Bloomberg's Kayleigh Lines. Again, former President Donald Trump detailing some of his economic plan at the Economic Club of New York. Let's take a listen.
Indeed. A very special thanks to Barbara Van Allen. Barbara, thank you very much. And former Director of the National Economic Council, Larry Kudlow. What a job. Former Chair of the Council of Economic Advisors, Kevin Hassett. Ambassador Robert Lighthizer, terrific person. Former Secretary Wilbur Ross, former Treasury Secretary Steve Mnuchin, former SEC Chairman Jay Clayton, Ambassador Woody Johnson, Senior Advisor Stephen Miller, my friends and respected business leaders all, John Paulson, Jamie Dimon, Steve Witkoff, Steve Schwarzman, Scott Bessent, Jeff Sprecher, Richard Kurtz, former head of the World Bank, David Malpass, and the two co-chairs of my presidential transition team that are being inundated with phone calls and requests, Linda McMahon and Howard Lutnick. Thank you. Thank you very much. As we gather today, we have an economic disaster on our hands. We have an economy in crisis, a failing nation, a nation in serious decline under the radical policies of my former opponent, Joe Biden, and my new opponent, Kamala Harris. 1.3 million workers have become unemployed in the past 12 months. I don't know if anybody knows that. The typical American family has lost over $28,000 due to rampant and record-setting inflation. Credit card debt has reached the highest in history, with more than 1 in 3 Americans reporting They have maxed out their credit cards. They've maxed out. Families now need to earn an estimated $110,000 a year to afford a typical home, meaning 65% of households are locked out of buying just an ordinary house. Gasoline prices, grocery prices, electricity prices, mortgage rates, and virtually everything else are up 30 to 100% since I left office. 8.4 million Americans are now working second jobs, the highest in more than 30 years. The real wages of African American workers are down by over 6%, a short period of time. The real incomes from Hispanic men are down 6.6%, or $3,600 per year. And on top of that, African Americans and Hispanic American jobs are under massive threat from the invasion taking place at our border. They're taking the jobs of Hispanic Americans, African Americans, and nobody talks about it. But I won't let it happen. Yet after presiding over the border, the worst in history for any country, there's never been a border like this. 21 million people, we project. This total economic catastrophe, the border czar, Kamala Harris, has now been slotted in by the Democrats to be reelected. She wants 4 more years to enforce a radical left agenda that poses a fundamental threat to the prosperity of every American family and America itself. And we're talking about America itself. She wants to defund the police, have totally open borders, ban fracking in Pennsylvania and everywhere else, take away your private health insurance, and perhaps most pertinent to the very brilliant people in this room, raise your business and corporate taxes, and unbelievably, she will seek a tax on unrealized capital gains. Most people don't even know what that means. What does it mean? She has been after all of this for years, and as everyone knows, she's a Marxist who destroyed almost single-handedly San Francisco, and when she was the AG, California itself, not the same place. People are leaving. They're fleeing like they are in New York. She'll seek out and she will try and get those things if she's elected, and she may very well succeed in getting them. She recently said her values have not changed, and these have really been her values for her entire career. Her values haven't changed. That's what she wants. So she told the truth. We're not going to let this happen. Communism is the past. Freedom is the future. And it is time to send Comrade Kamala Harris back home to California, where crime is rampant and fleeing is the #1 occupation. I'm here today to lay out my plan to rescue our country from this nightmare and to bring back to its citizens the American dream, bigger, better, and stronger than ever before. 8 years ago, I came before you as a candidate for president and shared my vision to end the stagnation and return to rapid growth. That's what we did. As president, I am very proud to say that we accomplished something that nobody thought that was even possible. Before the pandemic, real median household income rose by $7,684. And even after the pandemic, annual incomes were up $6,400. The average American household saw a $197,000 increase in real net worth in 48 months. For the bottom 50% of households, average wealth more than doubled, increasing by 121%. Lowest income people benefited the most. After 12 years of decline, we added nearly 7 million new homeowners, never happened before, And in 3 years, we created 7 million new jobs, 260% more than projected when I took office. When I took office, they said you couldn't hit those projections, and we were 260% higher than what we said we could do. From the day I won to the day I left, the S&P 500 increased by 80%, and we did it all with virtually no inflation. We had virtually no inflation. Think of that. Who could believe that? I delivered the largest tax cuts and reform in American history by far, slashing rates for working families and cutting the business tax from the highest in the world. We had the highest in the world, 35%, and actually, when you add local and state numbers that were getting close to 50, but much, much higher. Nobody's ever seen. We brought it all the way down to 21%, which everybody said was impossible to do. And I heard it from everyone. They said, you'll never be able to do that. And I got it down to 21%. I cut a record number of job-killing regulations. In 4 years, we cut more regulation than any president in the history of our country, by far. I'm proud to be the only president in modern history to achieve a net regulatory reduction during my term, and it was a substantial reduction, and for every regulation we added, we cut more than 5.5 regulations. We unleashed American energy, and within 3 years, we had increased domestic oil production by 47%, and we were just getting started. The price of gasoline was $1.87 a gallon. Doesn't that sound good right now? We negotiated and renegotiated more than 50 trade agreements with other countries that were taking advantage of us, as they all do, to protect the American worker and to open foreign markets, and we did a great job. I ended NAFTA, the worst trade deal ever made in the history of our country, and replaced it with the USMCA, perhaps the best trade deal ever made in history. That's Mexico and Canada. I stood up to China like no one else before me. No one came even close. And I saved the U.S. auto industry from obliteration with a 27.5% tariff on all Chinese cars that remains in place to this day. They want to take it off, but they can't, because number one, it's too much money, and number two, we would be invaded by Chinese cars on top of the other invasions that are taking place. Without it, our auto industry would be dead. And now I am going further. We will bring our automaking industry to the record levels of 37 years ago, and we'll be able to do it very quickly through tariffs and other smart use of certain things that we have that other countries don't. For 4 straight years, I fought for American workers like I would fight for my own family. I took care of our economy like I would take care of my own company. In every decision I asked, will I create jobs here, or will I be sending jobs overseas? Will it make America richer and stronger, or will it make our country weaker and poorer? I always put America first, every single time. And when our country was hit by the China virus, we saved the economy. We rescued tens of millions of jobs. And after COVID, I handed Kamala and Joe the fastest and strongest recovery ever recorded, nothing even close. With 1.4% inflation, the 30-year mortgage rate was at 2.4%, and the highest stock market in history. This is despite the pandemic. To date, I handed them back the highest stock market to date, after having just suffered with the rest of the world a pandemic, the likes of which nobody had ever seen before. We did an incredible job, and remember, far more people died of COVID under Biden-Harris than under President Trump. Many, many more people. We delivered an economic miracle, which Kamala and Joe turned into an economic disaster, just like they turned the border and indeed the whole world into a catastrophic surrender. Starting on day one, Kamala launched a war on American energy and orchestrated a nation-wrecking border invasion with illegal aliens pouring in from countries all over the world. They came in from countries that nobody ever heard the name of that country. Those countries, from their prisons and jails, there is a difference, from mental institutions and insane asylums, as well as record numbers of terrorists, human traffickers, and sex traffickers. Numbers that we've never seen before taking place over the last 3.5 years. Then Kamala cast the deciding votes on trillions of dollars in wasteful spending, which together with their terrible energy policies gave us the worst inflation perhaps in the history.
We're monitoring former President Donald Trump speaking to the Economic Club of New York. Right now we're anticipating some questions to come in a few moments as soon as he finishes a speech. For more on what he has said, though, let's bring in Bloomberg's Kayleigh Lyons. So Kayleigh, we did hear some of the things we were anticipating hearing. Did you hear anything new from Donald Trump yet?
No, although a lot of this are repeated misstatements of facts or misleading presentation of the facts, Vonnie, including when he talked about some things that he accomplished or he said he accomplished in his first administration when it comes to tax cuts, for example. Once again, he said here that they were the largest in American history, according to the Committee for a Responsible Federal Budget. That is actually not true as measured as a percentage of GDP. They were about the 8th largest. He, of course, as we just were hearing, made a number of misstatements about the border without providing evidence around mental institutions and insane asylums, prisons, the idea that more than 20 million people have come across the border. But by and large, this speech so far is really criticizing the policies of Joe Biden and Kamala Harris and what she has put forward, and reflecting back on his prior years in office and the presidency that, of course, ended at the beginning of 2021. We have yet to hear from him in this speech what he would like to pursue in a second term in the Oval Office. As I said before he began speaking, we are expecting he will outline a government efficiency commission he would like to put into place to cut wasteful areas of spending in the federal government. We also are expecting him to talk about corporate tax cuts, lowering the corporate tax rate for companies that make products in the U.S. But he has not gotten to any of that potential policy to this point in the speech. It really is just him rehashing a number of things we have heard from him before.
Exactly, and he has about another 10 minutes to speak before we get to the Q&A, and presumably there will be some difficult Q&A. He did, of course, mention all of the people in his camp that are in the audience, and of course it will be a big audience at the ECNY. He talked about things like the 30-year mortgage being at 2.4% when he was in office, and the stock market at an all-time high, and so on. These things are true, Kayleigh, but for various different reasons. This will give Kamala Harris an idea of what to expect, though, for Tuesday night, if she didn't already anticipate some of these.
Yeah, absolutely. That debate, of course, coming up on Tuesday, and perhaps Donald Trump's conduct in this Q&A that is about to take place when he finishes his prepared remarks may be indicative of the kind of answers he could get when pressed on these policies during the debate, though it is worth pointing out Kamala Harris could get pressed on these issues as well. She, of course, has floated higher tax rates in order to offset some of the spending she would like to see, but she is still talking about subsidizing things like first-time down payment assistance for first-time home buyers and a higher tax credit for small businesses. All of those things cost money, too, and economists have told me that she could have deficit additive policies just the same as Donald Trump. So they could both face difficult questions when it comes to some of the things that they are outlining here. What I would note as we think about kind of what could translate onto the debate stage, by and large, Donald Trump does seem to be sticking to his prepared script here. We often see him in speeches like this veering off to different topics, clearly going off the teleprompter. That doesn't necessarily appear to be happening as he speaks before the Economic Club of New York today.
Yes, exactly. I noticed that as well. So we'll see what he happens to respond with when it comes to the Q&A. Bloomberg's Kayleigh Lyons will be monitoring that throughout the hour and bring you more as it comes. In another part of Midtown, happening at our world headquarters, in fact, Bloomberg Power Players, where we gather industry leaders, investors and athletes who are revolutionizing the business of sports. That's going on right now. So let's dive into the Carlyle Group's David Rubenstein, owner of the Baltimore Orioles, speaking to Orioles legend and Hall of Famer Cal Ripken Jr. He's also part of Rubenstein's ownership group.
Wednesday 12 o'clock game. If you keep moving the times of the games around, your body wants to get into a routine, into a schedule. And it's hard nowadays with the different times and travel.
When you're a professional baseball player or a former professional baseball player, as famous as you are, people come up and all the time they want autographs, selfies, and they say, I hate to bother you, but can I bother you with a selfie or an autograph request? What do you say? You say, I'm too busy, or you just do it? Or how do you deal with all that? And when you go to a hotel and you're a Major League Baseball player, people have all these little kids who are trying to get autographs. How do you deal with all that?
When you get old, they don't do it so much anymore. No, I'm thankful that I still can't believe that I get recognized as readily as I do. And to me, you always keep in mind, and sometimes someone approaching you, they're all nervous and they lose their mind and they say, you know, you're my biggest fan, and I go, I am? But they lose it. But then you have to keep in mind that it's meaningful to them. And so at that moment, you know, by signing your name for a little kid and their eyeballs get all, and they run back to their mom or whatever else and say, look what I got. So, you know, you help that happen. So if you remember what happens afterwards, you know, focus on, you know, and you just manage it. You just get through it.
And what was it like the day that you broke the record of Lou Gehrig? There was enormous fan outpouring. Everybody's calling you. You're nationwide TV, and you're running around the stadium and so forth. Was that like the highlight of your life professionally?
I would say there's two moments. I answer that question in two parts. The best feeling I ever had on the baseball field was catching the last out of the World Series 42 years ago. 42 years ago? 41 years ago, 1983, little humpback line drive. When you catch it, this part of the dream of being a baseball player is to win the World Series. And then now, because I caught the last out, I won the World Series. So that's the best feeling. Second best feeling, and probably the best personal moment, was the lap around Camden Yards. I was embarrassed that the game was stopped because the game became official halfway through. And then everybody kept clapping. I kept saying, thank you, thank you. And then Bobby Bonilla and Rafael Palmeiro pushed me out of the line and says, you're going to have to take a lap around here before we'll never get the game started. And I thought it was a silly idea. So I went around, started shaking hands. The celebration went from almost 50,000 down to like one-on-one. And it was kind of cool that way. And by the time I got down to third base, I could care less if the game ever started again.
When you got to 2,632 games, you didn't get injured. You just volunteered to say, I don't want to do it anymore. Why did you decide to not keep going?
I was tired. No. I felt that there was some support that was being gone. We were going through another rebuilding process at that time. You know, when you're not going well, there's fingers pointed all over the place. I just thought it was the right time to reset it. You know, and so I went into the manager's office 5 minutes before the game and said, he said, this is it, and I came.
So now that you're an owner of the Baltimore Orioles, how do you feel about these high-priced contracts that players are getting? You used to be a player who probably wanted higher-priced contracts. Now you're an owner. How do you look at that? Differently?
Slightly. I try to think of what are the other intangible values that you can offer a player besides the bottom line dollars, because the bottom line dollars are so big now, or whatever else, that you can make a case you're saying, well, how much? But I mean, it's about ego, and it's about breaking the bank, and it's about agents wanting to continue to make it go up for other people that come through. But if you take my situation was I wanted to play in one place. I wanted to have control of playing in one place. So I think if we get to a point where we're trying to convince one of our players to stay, you know, you want to try to tell them all the values that are associated with, you know, Derek Jeter playing his whole career in a pinstripe uniform, me playing my whole career in the Orioles, and what's that mean for you in the bigger picture? And hopefully they'll value some of that, but it's going to be a competitive landscape where we're going to have to pay some salaries.
And Baltimore is a smaller city compared to some of the New York teams or Los Angeles. Is that a big problem when you're in a smaller city in Major League Baseball?
I think overall, I never liked the idea because you were a small market team you couldn't compete. Because I think competition is in your knowledge. You know, you're drafting, you get to draft, you get to sign players, you get to develop players. You know, that's not all free agency that's happening. But if you're a big market team and you make a mistake in judgment on a player, you can throw more money at your mistakes. When you're a smaller market team, you have to be better at your baseball decisions.
Look, we're out of time. I want to thank you for being here, and thank you for what you've done for baseball and for Baltimore over many, many years. And if you had seen me when I was younger, do you think I could have learned how to be a professional baseball player? Is there any chance I could have been given my physique, or do you think it wouldn't have worked?
I think you made the right choice in your career.
All right. Thanks very much. Good to see you. Thank you.
What a diplomatic answer there. Well, if you want to watch more of that interview with Cal Ripken Jr. and even catch the interview with Steph Curry happening later today, tune in to Live Go on the Bloomberg terminal or stream it on Bloomberg.com. All right, let's get back to today's markets. A quick check on the markets. They are off their lows now. We are seeing the equal weighted S&P down lower than the S&P 500. That depends on the Mag 7, which is an interesting phenomenon to observe. This rally that had been, giving itself some more breath doesn't seem to be doing that, at least today. Now, the SOX index is lower once again. It was rebounding, though, after a very tough week. Not so much the case now. We do have several stocks higher, but most of the stocks lower. In terms of the yield curve, we are very much flirting with disinversion again. There's just a basis point or two in it. We're pairing those gains for treasuries ever so slightly after today's data showed a little more weakness in the labour market. And of course, as we wait for the non-farm payrolls Friday. But let's get some individual midday movers now on the equity side with Bloomberg's Abigail Doolittle. Abigail.
Well, Vonnie, it's interesting because we have that S&P 500, as you mentioned, down about 0.5% at this point. But beneath that surface, there's a real tug of war between the gainers and the laggards. To the upside, Tesla is the top point boost. And I think last I checked, it was the top percentage mover as well. And it's interesting. This is on the news that the company in the first quarter of next year in both China and Europe is planning on offering a service to help auto driving, and folks very excited about this. They're also going to have soon, get this, Vonnie, snow tires for that cyber truck. Whatever the cause is, it could also just be buying the recent dip. We do have Tesla up sharply. JetBlue up more, up 8.5%. They pre-announced to the upside on their revenues. They basically raised that guide. And it's interesting because that CrowdStrike technology debacle that we had back in July, that really grounded a lot of the Delta Airlines planes along with some of the other airlines. Apparently, JetBlue was really able to scoop up some of those passengers, and that is why they're raising their revenue. To the downside, though, McKesson down 9%. This has to do with the healthcare distributor. They have distributed 2 lines of their business, and apparently it's going to weigh on EPS to the tune of at least 25 cents, along with revenues, investors trying to figure out what that simplification will mean. And then Hewlett-Packard down 5.5%. They beat on revenues, they beat on sales. The AI business was strong. However, the traditional server business, not as much, and that weighed on servers. Let's take a look at the big one, though, Vonnie, the one that has been moving all over the place on the day, on the week, on the quarter, and that, of course, is NVIDIA. So this is a 6-day view, and ahead of today, this stock had been down over this time period. Let's call it 16%, but this is a 1-day percent change, so we can see what's happening right now. And we do see that this stock up 1%, offsetting some of the other chip weakness. Earlier, that stocks had been down more than 1%, but again, NVIDIA strengthening a little bit here. Although, Vonnie, I will caution technically, not looking at that chart right now, it appears that there could be some weakness ahead in line with this downtrend. But right now, investors trying to fight that.
Yeah, absolutely. A little bit of optimism after that Bank of America report suggesting that there should be a little bit more optimism about NVIDIA. And of course, don't forget, we get the last barometer reading for the quarter on AI with Broadcom earnings after the close. Thanks, Abigail Doolittle. For more now, let's bring in LPL Financial Chief Global Strategist, Quincy Krosby. Quincy, how concerned are you about the labour market right now?
Well, it's definitely slowing. There's a difference, though, between slowing and normalizing versus, collapsing, and whether or not we need a 50 basis point cut at the next Fed meeting. It's going to be interesting, obviously, Friday morning, tomorrow morning. And it's interesting further that right after the release, we'll have 2 Fed speakers. And the question will be, if the numbers are weaker than expected, the market's expecting about 162 to 172 new job openings, also expecting the labor unemployment rate to come down a bit. If it goes the other way, we'll hear whether or not they start leading the market towards 50 basis points. I'm sure they're talking about it, because what will have to happen before they go into the blackout period is they could guide the market in some way, suggesting that perhaps the Fed moves bigger. This is very important for the market, because we all know that the market wants to see the Fed cut rates because inflation is coming down and the higher interest rate regime is not warranted. So it's going to be extremely important. Right now, also, there's questions in the market as to whether or not we break 54, 55 on the S&P 500. That debate is ongoing, along with the Ravens and the Chiefs. Right now, we'll see where the market closes, because the question is, do we have more to go on the way down? And is this a precursor or probably the end of the downturn in the notorious September? Because normally the worst comes in the second half, beginning technically September 16th. So an awful lot riding on the market right now as to whether or not the Fed goes 50 and quote unquote scares the market, or whether or not it stays at 25.
Yeah, I mean, as Neil Dutta says, do it while you still can. I mean, there's an argument for getting it out of the way. And, you know, if there's going to be a market scare, to even get that out of the way fast before things might deteriorate later in the year. But then there's also an argument for waiting and being very sanguine about the whole thing and say, oh, well, now, you know, we've done some, let's do a little bit more. Quincy, would you be a buyer tomorrow if we, you know, get data that reinforces the 25 basis point notion?
Most likely the market is going to be buying on the dip. The market's looking for the way August ended, right? And August ended with newly minted 401k millionaires, and then suddenly everything turns ugly. The market will then take a deep sigh of relief, and then we'll probably start pulling out of this. But we expect to see more bouts of volatility before September is over, in fact.
So we've seen a huge amount of volatility, but what exactly has changed? Because if you look at it, you know, there was a little bit of a broadening out of the rally, but that seems to have stalled to some extent. There have been moves in treasuries, I'll give you that, but even the move lower in chips, we've seen it before. They are growth stocks. They're allowed to move around a lot, and it's very possible that they'll, you know, recoup many of these losses already. How do you know?
Well, we'll know. I mean, just to give you an example, we just heard Broadcom is coming after the close. Broadcom is extremely important in the AI infrastructure picture. I mean, they help with the generative AI and the processing. We'll see whether or not buyers come in if Broadcom delivers, and we'll look at the aftermarket. But the fact of the matter is, AI is not going away. It will probably just pull back. And once the valuations pull in, and, you know, with NVIDIA, by the way, we see it trying to pull up. There's commentary in the marketplace that they did not receive a message from the government, that was perhaps false. So we have to get through that saga. But overall, it's not going away. The question is the valuation and whether or not capital expenditures from the hyperscalers, the Microsoft, Amazon, Meta, so forth, whether or not that continues at pace. What the market wants to see above all else is, let's see it integrated. Let's see it integrated into your products and monetized. And perhaps we get a picture from Apple when they come out with their upgraded phone, supposedly, that has more of the AI embedded in it. We'll see what the market's reaction is there.
Just on the NVIDIA comments, what they said was they didn't get subpoenaed, but in some senses, this may just be a difference of words. So we have to see exactly what happens there. But there are obviously some challenges ahead. And that was also recognized by Bank of America this morning, which said, you know, that these challenges don't mean that the stock won't go higher. So Quincy, 10-year yield, I mean, your background is so much in fixed income. Next 15 basis points, lower or higher?
That's a really hard one. But the fact of the matter is, if the number comes out and it shows that we've gained jobs, that the unemployment rate has come down, we could probably see it tick higher. All right.
Quincy, thank you so much. Always a pleasure to speak with you. LPL Financial Chief Global Strategist Quincy Krosby there. This is Bloomberg. This is Bloomberg Markets. I'm Vonnie Quinn. Well, President Donald Trump, former president, still speaking with the Economic Club of New York right now. The question and answer session hasn't started yet, but as part of this story, we've been following Nippon Steel's $14.1 billion takeover of United States Steel Corp. It's on the verge of collapse, with President Joe Biden preparing to block the deal. It's a point of tension with potential domestic and international ramifications. Biden now expected to make remarks on the economy today at 4 p.m. Eastern. To speak about all of this now, joining us is Director of Economic Policy Research at Veda Partners, Henrietta Treyz. And Henrietta, I just want to point out that President Trump has just been talking at the Economic Club about cutting corporate tax rates to 15% for some companies, though they must make products in America to get the tax cut to that level. So we're on the tax portion of the session right now. But this U.S. Steel story, is this just a political ploy? It strikes me that, the national security concerns are a bit dubious, right? And I just wonder how this plays out. U.S. Steel is just such a minnow compared to Nippon Steel.
Yeah, if you bring Ohio and Pennsylvania into a conversation during an election year, you're going to get politics involved with any merger, particularly one that has 1.2 million steelworkers union members in play. So I think for the last year, investors have appropriately been focused on wondering whether CFIUS and Treasury Secretary Yellen would allow this deal to go through. And I think it stands to reason that you should expect delays. President Biden is anticipated to make comments about whether or not he'll allow it to go through, but I expect him to be relatively squishy and allow for future negotiations, particularly a stronger hand for the union workers to be a major factor of his announcement as he tries to shore up Pennsylvania for Kamala Harris in the Democratic caucus.
You think that's the play here? Because essentially, if the deal doesn't go through, there are likely to be job losses in the U.S., right?
The job losses are definitely real, per Nippon Steel, per U.S. Steel, per talking about all of the different factories they have in Pittsburgh and the surrounding areas. But I think they're trying to make it clear that unions need to have a strong hand in this conversation. The unions have gone in both directions in the past, trying to understand what's the best for the future of their, again, 1.2 million steelworker union members. And you have a conflict where at the top of the union, you have strong support for the Democratic candidate, and then downstream amongst the actual members, you have a lot of supporters for Donald Trump. So I think they're trying to thread the needle both ways on this one. And obviously all of the Democratic candidate and the Republican candidate have come out against this deal.
Is it possible that this is the question that flips Pennsylvania?
I don't think that this question is going to flip Pennsylvania because I don't think it's going to be resolved in sort of a binary black or white way. As I mentioned, I think it's going to be a little bit squishy and ambiguous about what comes next. But I do think Pennsylvania is going to be razor thin. Biden only won that state by 80,000 votes last time, and he's from Scranton. So I think it's going to be a really tough lift for Kamala Harris, and they're doing everything in their power to try to make it swing their way right now.
Henrietta, thank you so much for standing by for us. If we had got Q&A, we would be asking you about some more of President Trump's comments, but we thank you, Veda Partners Director of Economic Policy Research, Henrietta Treyz. And on to our stock of the hour now. We're watching Verizon. It's agreed to buy rival telecom operator Frontier. Verizon CEO Hans Vestberg joined Bloomberg TV earlier today.
This is very straight into our core strategy. We are sort of in mobility and broadband, serve basically all types of customers in this market, consumer, SMBs, large enterprise and governments. This is just extending the offerings and optionality for the customers we have. So this is a really good decision by us to do it.
Frontier's investors will get $38.50 a share, a 37% premium over Tuesday's closing price, assuming, of course, that they agree to it and that there are no regulatory issues either. Coming up, commercial real estate continues to be a looming risk. Will Fed action change the calculus for Wall Street? We'll discuss next. This is Bloomberg. This is Bloomberg Markets. I'm Bonnie Quinn. As Wall Street anticipates rate cuts beginning in September, Fed Chair Jerome Powell has said commercial real estate risk could be with us for years. For more, let's bring in Bloomberg's Abigail Doolittle and Hines CEO and CIO, I should say, David Steinbach. Now, Hines runs about $100 billion worth of commercial real estate as the largest private investment manager in the space. So, David, you're bullish, even though there are plenty of warnings out there. Explain why so bullish.
Well, I think it's important to remember that the private markets are in a much different space than the public markets, and the public markets have obviously had a long time now to recover. I think now with this impending Fed adjustment next week, I think that will be a psychological pivot point for the market to bring a lot of clarity that we're hitting bottom. And I think this will help to entice a lot of investors to come back into the private side.
So one area of commercial real estate that everybody universally seems to hate, and it's down so much, some office buildings over here on 3rd Avenue could go for 10 cents on the dollar office. But you have a different view. Explain.
Yeah, look, what we're seeing is a real disconnect between fundamentals and capital markets and office. And some of the best office projects from a leasing perspective are actually doing quite well. The last 20 years, 6% of the total inventory commanded about 25% of the activity, the leasing activity. And we're seeing that really continue today. And so that disconnect does not make sense to us. And we think that the market will begin to recognize that. We're starting with credit and our dollar costing with equity. So we are a bit more cautious on the equity side, but we do see an opportunity there.
So what's your favorite sector right now?
Right now, actually, our favorite sector right now is more retail and multifamily. Both those sectors have different dynamics around them that make them very interesting. Retail has had 15 years of being reworked, and there hasn't been much product delivered in that 15-year period. With the living sector, it is typically the first in, first out in a correction, and so that makes it a very interesting sector, combined with the U.S. is about 3 million houses short.
So if the Fed, of course, is widely expected to cut 25 basis points, maybe even 50 basis points this month, how much has to be cut? Other real estate investors have said that's nothing, that's not going to do anything. How much does the Fed have to cut to really bring in the bottom that you think is here for commercial real estate?
Right, so we've been on a 30-month journey where the Fed's increased rates 500 basis points over that time. And so certainly if it's 25, 50, when you're dealing with 500, it isn't going to extremely move the needle. To me, it's more of a psychological point that it's what the market's been waiting for in terms of now we're on the other side of the challenge that Jerome Powell's had. It's also interesting to see that since 1962, we've had 9 different versions of having to tame inflation through interest rate increases. 8 of those resulted in a harder recession. So it is certainly becoming more clear that the market is headed more for a soft landing, and I think that also gives investors a lot more confidence that this time it is the exception, which Powell seems to have pulled it off.
And you, of course, are global.
And so we'd like to thank you, David Steinbach, Chief Investment Officer at Hines. Thanks for joining us. I'm Bonnie Quinn. That was Abigail Doolittle as well joining us. So thank you, Abigail. That about does it for Bloomberg Markets. President Trump still speaking to the Economic Club of New York. Hasn't got to the Q&A portion yet. And of course, the Power Players session still going on here in New York. Do get to your live go right now. This is Bloomberg.